the Federal Reserve continuing to see downside risks to the economy, meanwhile, and it may be no surprise that interest rates remain unchanged from where they are right now. This coming on the heels of the worse-than-expected GDP report out today. But that same report also had some bright spots, like consumer spending, for example. So as the economy shows signs of improvement, does it still make sense to keep rates at zero? CNBC contributor and former Dallas Federal Reserve President Bob McTeer is with us. He has some ideas on how to keep monetary policy accommodative, but let interest rates move higher. He joins me now along with our own longtime economy and Fed watcher, Larry Kudlow. Gentlemen, good to see you. Thanks for joining us.
Thank you, Maria.
Bob, first to you. What's your takeaway from the GDP report today? Some say it isn't as bad as it looks. It looks pretty bad, given it's a contraction.
No, it's not as bad as it looks. There's some really good news in it. You mentioned consumer spending. I think the best news was investment spending, both fixed and residential, was up very nicely. And the negatives, inventories go up and down. And last quarter they went up a good bit. This quarter they went down. That's not all that big a deal. I don't know what to make of the government decline, primarily military. I hope that's a timing issue and isn't a sign of things to come in the military.
What do you think, Larry? What's your analysis here?
Well, Maria, I actually agree with what Bob is saying, or the thrust of it. When you look at the gains in housing and you look at the gains in business investment, even consumer spending, the private economy, put the government stuff, the military stuff aside, the private economy actually grew at 3.4% at an annual rate. And that's a pretty strong number. And that tells me that even if government spending comes down, as it will in the sequester scenario, the private economy can keep rising. In fact, we saw the bulk of the Defense Department's cut in spending this quarter. They were already prepared for it. 40%, 4/5 of the adjustment was already made. We're not going to see it again. Therefore, I say go ahead with the sequester. Let the private economy breathe. Let's get spending down and a lower rate of GDP.
Yeah, I mean, that's all obviously sort of prudent thinking, Larry, but that's not what's happening, right? We continue to see this fight over spending cuts.
Well, I don't know. I mean, I think the clock is ticking to March 1st. And we heard from Senator Harry Reid yesterday that he wants to postpone or defer the sequester and then put tax hikes in there. It'll never pass the House. My contacts,
right.
Every one of my contacts in the Senate and the House, Maria, say the sequester is going through. And
yeah.
I think maybe too much on defense. Okay, maybe they can adjust that. The sequester should go through. There's never a good time to cut spending in Washington. These guys always find excuses.
Yeah.
I say there's no time like now. Just go ahead and do it. And a GDP report like today shows, you know what? The private economy can grow in that kind of environment, just like all over the world. Lower spending, good for the economy.
You're right. Bob, you recently wrote a piece that suggests allowing rates to rise without actually tightening monetary policy. How does that work?
Well, I'm not sure it would work. At the December minutes of the last FOMC meeting, or next to the last one now, seem to treat interest rate policy and quantitative easing separately. And the implication was we'd have low interest rates for a lot longer than we would have continued quantitative easing. I just think the economy would be healthier if they do the reverse of that and allow interest rates to tick up a little bit, allocate capital a little more effectively, but using quantitative easing, not let the money supply shrink, keep it growing slowly.
Do you think we are going to see a spike in rates? Markets will push rates higher at some point. When would you expect rates to start moving up, Bob?
Oh, well, when the economy starts showing a lot more health than it is now, and if inflation starts ticking up, I don't see either one of those things happening for another quarter or two.
And I guess
let me mention, Maria.
Yeah, go ahead.
I forgot to mention a big negative in the GDP number, and that is exports and imports. They both declined. Exports declined more, so it was a net negative for us. But that's a bad sign for world trade. We don't want to see world trade shrinking.
Could be a one-off, though, because remember, Maria, we are becoming energy independent, and our imports of foreign oil are sinking like a stone, especially if the government keep hands off. So I'm not so worried about trade deficit. Can I just say this? Second half of this year, it wouldn't surprise me if long-term rates, bond rates, go up, okay? I think bonds are way overvalued right now. I don't know if you saw the Wall Street Journal this morning. Here's the Fed's big risk. They did some simulations internally. if and when bond rates go up and prices go down, Maria, the Fed is going to lose a fortune. The Fed could lose as much as $150 billion to their portfolio. That would do any commercial bank in. They won't be able to give money to the Treasury, and they're going to have to print more money just to cover some of their operating expenses. That's how high a risk the Fed is taking right now if bond rates go up and prices down. And you and I and Bob McTeer know at some point those bond rates are going up and prices are going down.
Yeah, well, the debate is out there as far as whether or not this easy policy should come to an end at some point soon, but we'll wait for the economic data. Gentlemen, thank you very much. We'll see you soon. We appreciate it. Bob McTeer, Larry Kudlow.